Today, sentiment hangs by a thread. The Property Imperative Weekly to the 19th of October 2019. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. In our latest digest, we look at Brexit, China's growth and US retail, as well as locally a couple of significant markets events, which gives us a read on local market sentiment. And the International Monetary Fund lowered its forecast for global growth this year to 3%, which would mark the slowest expansion since the financial crisis. And the growth projections for Australia also fell. As normal, we'll start with the international news, but if you want to jump straight into the local update, the time is shown below, and in the comments we list the topics and timecodes. And as I foreshadowed in our recent live event, we are going to make these updates shorter and hopefully more focused. On Friday in New York, Wall Street fell as negative headlines about Johnson & Johnson and Boeing, along with bleak economic data from China, turned sentiment negative, despite generally more positive corporate earnings than expected, where the third quarter earnings season has hit full stride with 73 companies in the S&P 500 having reported, of which 83.6% have come in above average estimates. But Johnson & Johnson announced it would recall baby powder in the United States after regulators found trace amounts of asbestos in a sample, sending its shares falling 6.2%. And Boeing dropped 6.8% after suggestions the plane maker misled the Federal Aviation Administration about the safety of the grounded 737 MAX aircraft. And American Express reported better than expected third quarter profits as consumers boosted their spending, but it was down 1.96% to 116.76. And US retail sales fell the first time in 7 months in September, raising fears that a slowdown in the American manufacturing sector could be starting to bleed into the consumer side of the economy. The Commerce Department said on Wednesday that retail sales dropped 0.3% last month as households slashed spending on building materials, online purchases, and especially automobiles. The decline was the first since February. Real consumption rose by 2.5% annualized in the third quarter. That's down from 4.2% in the second, with overall GDP growth slowing to just 1.5% annualized from 2%. This is not what the market was hoping for. Plus, growth of China's gross domestic product slowed to its weakest pace in nearly 30 years as the bruising trade war with the United States took its toll, stoking fears of slowdown contagion. The Dow Jones Industrial Average fell 0.95% to 26,770. The S&P 500 lost 0.39% to 2,986, and the Nasdaq dropped 0.83% to 8,089. And the S&P 500 and the Nasdaq posted weekly gains, but the Dow was nominally lower than last week's close. The volatility index was up 3.34% to 1425, gold was down 0.33% to 1,493, while crude oil ended at 53.72. Bitcoin slid 0.85% to 8,007, well down from recent highs. The Euro-US dollar was up 0.44% to 1.1171, while the US dollar futures index was down 0.48% to 97.14. China's economic growth in the third quarter slowed more than expected to 6% from last year, the National Bureau of Statistics reported. Analysts expected GDP growth of 6.1% year-on-year, and industrial output gained 5.8% year-on-year in September compared with an expected 5%, and retail sales rose by 7.8% year-on-year, and that's in line with expectations. But the protracted US-China dispute, which now goes well beyond just trade, has hit sentiment badly. More policy stimulus can be expected as growth is now on the brink of sliding below the official target, and of course the real number may already be significantly lower. The Shanghai Composite closed at 2,938, down 1.32%. and the Hong Kong's Hang Seng index was 0.6% lower. The US dollar yuan closed at 7.0817, down 0.06%. Meanwhile, in Europe, Britain's exit from the European Union hangs on a knife edge ahead of an extraordinary vote in Parliament. The numbers are too close to call. Johnson must garner 318 votes in the 650-seat Parliament to get a deal approved, yet his Northern Irish allies are opposed to a deal, and the three main opposition parties have pledged to vote it down. Parliament will sit from 8:30 GMT on Saturday. Johnson will make a statement to the lawmakers, after which there will be a 90-minute debate and then a vote. Goldman Sachs said it thought the deal would pass and raised its estimate of Brexit. With a deal on the 31st of October to 65% from 60%, it cut the odds on a no-deal departure to 10% from 15% and kept unchanged its 25% probability of no Brexit. The pound was up 0.66% on Friday to 1.2973, down from Thursday's peak of 1.2988. The FTSE was down 0.44% to 7,150. And shares in London's UK-orientated businesses such as house builders and retailers could rocket to record highs if Parliament agrees the government's Brexit deal, investors say. They also predict the pound will rally around 5%. British companies that earn most of their revenues at home have been shunned by investors since the 2016 Brexit referendum, as more than 3 years of uncertainty damaged Britain's economic prospects. Approval would remove some of the uncertainty that has eroded confidence in UK PLC and push share prices and the pound to trade at a big discount to global peers. And large overseas funds have steered clear of the UK since that referendum back in 2016. Even so, the UK faces a long period of weak economic growth, regulatory uncertainty and political scuffling with their largest trading partners. Fiscal stimulus by the German government and an orderly Brexit deal could shift the rate cycle upward in Europe, and Deutsche Bank, for example, might benefit, moving closer to its tangible book value. However, the interest rate cycle in Europe may be the biggest risk to Deutsche Bank's ability to be profitable in the future. Negative rates have made it very challenging for European banks to grow revenue and show consistent profits to shareholders. Deutsche Bank closed at 7.12, down 0.64%. Germany is also in the best position of any Eurozone nation to inject fiscal stimulus into their economy, which will be great for shareholders of Germany's biggest bank. For years, the German government has shown restraint in spending and has ended the year with a budget surplus in every year since 2012. Currently, the unemployment rate in Germany is just over 3%, but with the German economy slowing down, it's time for their government to borrow money at negative interest rates and use the borrowed funds on infrastructure spending. The German 10-year bond rose 0.78% to minus 0.383%. A Brexit deal would also be great news for Europe's economy and could help the ECB's case for raising interest rates. A no-deal Brexit would be horrible for Europe and clearly bad for business. Hi, it's Liz's interruption, but if you're getting value from this post and have not done so, please consider subscribing to this channel or ring the bell for custom alerts. Plus, please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. Alternatively, you can also donate using Bitcoin. Here is the QR code. The links are in the comments below. I really appreciate your support, which enables us to continue to make more great content. Thanks very much. Now, back to the current show. And so, on to the local scene. One of the biggest public offerings of the year, Latitude Financial, failed to list on the ASX this week on a second attempt. Latitude dropped the asking price not long before it pulled the plug on the IPO altogether, as it was not supported by overseas institutions who, perhaps wrongly, categorised Latitude, which provides a range of consumer credit, as a bank. But it's perhaps possible institutions were more concerned about having another short-term loan company listing on the exchange and how this might dilute demand for market darlings Afterpay and ZipPay. That said, offshore investors are starting to give Australian financials a wide berth. For example, professional indemnity insurers in London are turning down financial planning groups and significantly raising premiums for their long-term institutional clients. And as we discussed last week, global fund managers are ditching their Australian bank holdings in droves. New Zealand-based Copley Fund Research noted that an exodus of international fund managers has left domestic banks with their lowest uptake on record. And more pressure was revealed when the Bank of Queensland announced financial year 19 cash earnings of $320 million, down 14% on the previous year. The group said the poor results reflected a challenging operating environment characterised by slowing credit demand, lower interest rates, and a rise in regulatory costs. Net interest margins were compressed and mortgage lending down. Increases in expenses were more pronounced in the second half due to an increase in business deliverables addressing regulatory and compliance requirements. And the regionals are being crushed post-Royal Commission. Last month, Bendigo and Adelaide Bank posted a 6.6% fall in cash earnings after tax, citing $16.7 million in remediation costs and a 5.9% increase in operating expenses. And Suncorp Bank's profits were down 1.4% in financial year 19. The group blamed a challenging operating environment and economic conditions combined with higher regulatory and compliance costs. And so now to economics. Whilst the economic data was slightly better in seasonally adjusted terms, the trend 5.3% remains, according to the ABS data this week, and the participation was weaker thanks to less people seeking work. So no good news in these numbers, and way above the RBA's target. There were several RBA outings this week, including comments from Philip Lowe in Washington that the economy, though it's been through a soft patch over the last year, is actually now gradually improving. The commodity cycle is now in a slight upswing, he said, so the resource sector, which has been contractory for the last 6 or 7 years, is now in an expansion phase. And we've had some tax cuts, and the housing market, which has been in decline for the last year and a half, has now turned. So that's good in supporting household consumption. So he said, I think it's quite probable that we'll see a return to trend growth over the next year, which will be good. And that would help get the unemployment rate down, and gradually wages will pick up. And he all but ruled out negative interest rates, at least for now, though many would suggest that the economy is weaker than he indicated, and the latest IMF downgrade seems to confirm that. He did suggest that there was a high risk that some lower interest rates would inflate existing assets rather than stimulate investment in new assets, and that he is doubtful that macroprudential tools can mitigate negative risks of lower interest rates because of the non-bank sector. On the property front, the auction clearances were strong again on low volumes, with 2,022 listed auctions giving 1,225 cleared auctions and a weighted average clearance of 73.5% across the major centres, according to CoreLogic. And home prices continue to move higher in Sydney and Melbourne, according to their index, which is of course a pervasive source of data spread across media and analysts. But as I discussed with John Adams, we may all want to be a little cautious. Alongside the intelligence from REA that perhaps the true picture is a bit different thanks to low volumes of transactions and a bias towards more expensive property. It's worth watching for the bull trap as illustrated from trends in houses in Cabramatta, postcode 2166, where prices are falling again now on 50 sales down 18%. Then compare the trend in Blacktown, where units have continued to slide until recently on a 29% fall in volumes of 200 sales. Whereas in DY 2099, house prices have shot higher recently on volumes down 19.7% and from 49 sales. My point is simply averages mask. So average price momentum really does not help much, and yet they are oft repeated. And it's worth noting that more cracks are emerging in the Mascot Tower, according to the ABC. Urgent remediation is required to, quote, avoid a structural failure. Waterproofing systems used to excavate the basement levels of the neighbouring Peak Towers construction likely caused the erosion of fine particles and the destabilisation of land supporting the building. More concerns for the owners of this high-rise and for high-rise owners in general. And finally, to the markets, the ASX 100 was down 0.51% on Friday to 5,513, with all the banks weaker. The Bank of Queensland fell 2.87% to 9.15 on their weak results, and other regionals were also down more than 1%. The Aussie US dollar rose on a weak US dollar, up 0.48% to 68.56, and the local volatility index rose up 0.93% to 13.45, and the gold Aussie cross fell 0.55% to 2,174, while the Aussie Bitcoin cross slid 1.54% to 11,643. The Aussie Euro was flat at 1.6294. And so, in summary, the mirage of a Brexit agreement helped to prop up the markets, while China weakened some more. The trade negotiations meander on. Locally, the weak economic news continues, and our thesis of a weaker economy ahead on the back of China weakness is playing out. Meanwhile, the property spruikers are out, talking the markets up, despite the diverse real picture of what's happening on the ground. What is for sure is that the local banking sector will remain under pressure for some long time, despite desperate measures to try and flog more mortgages to unsuspecting buyers. The economic threads are wearing extremely thin. Finally, just a quick note to say I'll be answering the remaining questions from last week's successful live stream within the next few days. I just need the time to do them justice. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.